You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one place. Learn from elite educators and gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
Good morning, everybody. You know, it's interesting when I am giving long diatribes about how the market works. You are the man, Ellman, that actually makes the market works because you add liquidity to the market by what you do. And when you look at covered calls and how to make money, this is always a place that's a lot scarier to people. They don't, oh, how do I do this? How do I do? And you break that down for them. You make it very easy for people. So those of you that don't know who this is, Ellman, president of the Blue Collar Investor. I mean, he is the guy who's going to teach you how to make money when you really don't even know how to make money with your options. So I'm going to give it to Alan. Alan, it's all yours, my man.
Thanks, Steve. Appreciate it. Okay, I just need you to put up my PowerPoint. There we go. Okay, welcome, everybody. Last week when I spoke with Steve, we talked about one of my two go-to strategies, which is, as Steve mentioned, covered call writing, and how I integrated Bitcoin ETFs into that strategy. Well, today I'm going to do something related to that. We're going to talk about using Bitcoin to create both aggressive and defensive cash secured put trades. So selling cash secured puts is a strategy related to covered call writing, but not precisely the same. So once again, we'll talk a little bit about the strategy, and then again, how do you feel about the market? Are you feeling like it's a bearish, volatile, uncertain market? Or do you feel like it's a normal market defined as going up 8 to 10% a year, or even better than that, a bull market? So depending on how you evaluate the current market environment will dictate how you structure your trades, either aggressively, which I would say is a traditional manner, or defensively. So that being said, let's get started. So last week I mentioned a couple of things about using cryptocurrency in our option portfolios, and I talked about one specific exchange traded fund, iShares Bitcoin Trust, listed on the NASDAQ exchange under the ticker symbol IBIT. Now, what I like about crypto securities in general is that they have very favorable liquidity. There's a lot of interest in these securities, both the securities themselves as well as the options associated with them. And because they have such favorable liquidity, the bid-ask spreads are very tight, which means very favorable trade executions for us. So that's a big pro in terms of using these crypto securities. Now, another thing I like about them is they have robust implied volatility, which means that we can get meaningful returns while also allowing for protection to the downside. So that's also a positive. Now, when I say robust, I mean greater than an average security, but not crazy volatile, okay? Because things like, let's say, uranium ETFs is one example, they're going to have volatility through the roof. So that makes it much riskier to the downside. These crypto ETFs are almost perfect for selling options. Now, not for everybody, because some people prefer to take a more conservative approach. But for many option traders, including myself, these are really in my sweet spot. Now, in the same vein, having robust implied volatility also means there's greater risk to the downside compared to low implied volatility securities. So we have to be aware of potential exit strategy opportunities once we enter our trade. So that skill set must be mastered as well. So there are three that we must master. One, what underlying security are we going to select? And in today's discussion, I'm going to use IBIT. Then what option are we going to select? And in today's discussion, I'm going to talk about one option that would represent a traditional or aggressive approach, and then another one that'll represent a defensive approach. But whatever we decide and however we structure our trades, we always, 100% of the time, must be prepared for exit strategy opportunities, because trades could turn against us at any point in time, or they can end up way better than we anticipated. And there are actually ways of making more than a maximum return. So we have to be prepared with our exit strategies if and when those opportunities arise. Okay, so last week I defined covered call writing. This week we'll define selling cash secured put. So we sell a put. Selling implies that we get paid, and yes, we do. As soon as we sell that put, cash is immediately into our cash account in our brokerage platform. So what are we doing? When we sell a put, we are undertaking the contractual obligation to purchase shares at a price that we determine, that's called the strike price, by a date that we determine, and that's called the expiration date. Now, we, the option sellers, determine the parameters of these contracts. We determine the strike price and we determine the expiration date. The market will determine the premium that we receive. Now, it says cash secured. That means a broker is going to ask most retail investors like us to put a certain amount of cash into our brokerage account to secure that put. Because if we're undertaking the contractual obligation to buy shares at the strike price, the broker wants to make sure we can afford to do that. So here's the formula that will determine how much cash we have to set aside to then secure that put. We take the strike of the put, that's the price that we decide we're willing to pay for the shares. The broker will allow us to deduct the put premium from that price, and we multiply it by 100, and that will secure one cash secured put trade. Now, if we're doing more than one contract, we then multiply that by the number of contracts sold, and that will then dictate how much our cash requirement is. Now, what are the outcomes that can happen with these cash secured put trades? There are two potential outcomes, and we're setting aside exit strategies now. The first one is that the trade goes unexercised. In other words, the stocks or ETFs are not put to us, not sold to us. Well, then we just generate cash flow. You'll see in a moment what that potential is. The other possibility is that the option is in fact exercised, and we take no exit strategy possibilities to buy back that option and prevent those shares being sold to us. So no exit strategy intervention, we have exercise, and then what happens? Well, we're buying a stock at a discounted price from the price of the stock when we entered that trade, and you'll see examples coming up. So those are the two outcomes: either generate cash flow unexercised or buy the stock at a discount, exercise. Now, I'm here to tell you that these are low risk strategies, not no risk strategies. So if the price of the security drops below the break-even price points and we do no exit strategy intervention, we can start to lose money. So that's important. I don't want you to think this is a panacea where it's all win-win-win. If you master the strategies, it'll be mostly win-win-win, but not every trade is going to be a winning trade. All right, so how do we establish our aggressive versus defensive cash secured put trades? Well, in the BCI methodology, we almost always use out of the money puts. Now, for puts, out of the money means that we're agreeing to buy the shares at a lower price than current market value. Now, if we were going to do an aggressive or traditional cash secured put trade, which is what I do mostly, we're going to use slightly out of the money or lower than current market value put strikes. Now, if we wanted to take a defensive position, which I've been doing a lot of lately until we have more certainty with the tariff situation, then we're going to use deeper out of the money or much lower than current market value put strikes. Let me give you a hypothetical example before we get into the real life examples with IBIT. Let's say a stock is trading at 70. Well, an aggressive or traditional posture would be selecting the 68 strike, slightly lower than current market value. A more defensive posture would be to use the 64 strike, much deeper out of the money. Lower strikes means lower break-even price points, therefore more protection to the downside. Now, this is a screenshot of an option chain that I made yesterday. Okay, so that was July 15th, 2025. Now you can see here, this is for the August 15th a little more than a month out expiration. You could see it's a put option chain, and IBIT at the time was trading at 66.23. See at the top of this white box here. Now, what I want you to look at is the bid-ask spreads of the 58 strike, which is deep out of the money, much lower than the 66.23 price, and the 64, which is out of the money, but not quite as deep out of the money as the 58. Take a look at the bid-ask spread first for that deep out of the money 58. It's 66 bid, 68 ask. We always sell at the bid the lower, we buy at the ask the higher. The difference is 2 pennies, minuscule. How about the 64, more traditional or aggressive approach? That had a spread of 206 to 209, 3 pennies. Also minuscule. Why is that so? Because if you look at the all the way to the right, circled in purple, the open interest for the 58 strike is 93.13. That's how many contracts are open as of yesterday, midday. And as far as the 64, there were over 2,000 contracts of open interest. So huge, huge liquidity results in minuscule bid-ask spreads, which results in much more favorable trade executions for us. Now, next, we're going to calculate the returns based on that option chain. Now, I'm going to quickly show you the BCI Trade Management Calculator, TMC. I showed it to you last week for calls. This week, I'm going to show it to you for puts. In the blue cells, area number 1, we enter our trade. Area number 2, we have our initial calculations per trade. And area number 3, we have our initial calculations per portfolio. Now, if we move on to the middle section, which is the difference maker with this particular spreadsheet, because it allows you to manage your trades with over 20 different exit strategies. So in section 4, you can adjust your trades if that opportunity arises. And in section 5, you get your post-adjusted results per trade. And in section 6, per portfolio. Section 7 is a trade journal, so you can make notations or entries regarding the trades. And that makes it just a wonderful training tool for becoming better traders and investors. So what you're going to see today in this particular discussion is the entries in number 1, and then the initial calculations in number 2, with the portfolio initial calculations in number 3. Let's move on. Here are the trade entries now. And you can see that looking at the top part of the screenshot by the green arrow, the price of IBIT yesterday was 66.23. Now we're going to look at the 58, deep out of the money, the 64, slightly out of the money, put strikes. You recall that the bid prices were 66 cents and $2.06. So let's have a look now at the results. And you can see here with the in the brown area for the deep out of the money put rather, it's a 32-day, you see all the way to the bottom right, 32-day return of 1.15%, annualizing out to 13.13%. Now, what happens if the price of IBIT drops from 66.23 to below that 58 strike, and we take no exit strategy intervention to buy back the option? Well, then we'll purchase IBIT at a break-even price point of 57.34 in the yellow cell, and that represents a discount of 13.42%. Now, if you take a look at the 64, slightly out of the money strike for 206, you could see that the annualized return in the purple cells here goes all the way up to 37.93%. Based on that 32-day trade. So that's almost triple that of the deeper out of the money 58 strike. But what if the price of IBIT drops from 66.23 to below the 64 strike, and we take no action to buy it back? Well, they'll purchase IBIT at the break-even price point you see over here in the yellow cell, which represents a discount of 6.48%. So you could see the pros and cons of the deep out of the money, greater protection to the downside, all the way down to 57.34, but a lower return, 1.15%, whereas the slightly out of the money 64 strike gives a much greater return, 3.33%, but a break-even price point higher, more than $4.50 higher at 61.94. So you have to make a determination as to what your considerations are for the current market environment, how much risk you're willing to take, and then you could craft your trades based on those parameters. So let's summarize now before I go back to Steve. Bitcoin can be integrated, and I do it all the time now for the last 6 months. I've been using IBIT into our covered call writing and cash secured put trades while still aligning with our goals of cash preservation and low risk, but yet significant initial returns. Trades can be aggressive. In this case, it was 3.33%, 37.93% annualized, with protection to break even of 6.48%. Look at that. Very significant returns and still very significant protection to the downside. And it can be actually crafted in a much more defensive manner with a 1.15% 32-day return, 13.13 annualized, still significant. Yeah, imagine if your bank had a CD for 13%. Okay, and protection to the break even, in this case, about double that of the more aggressive position, 13.42% protection to break even. So what do I like about crypto securities? Well, they offer favorable liquidity and robust implied volatility, making them, for people that have modest risk reward profiles like I do, low risk but not crazy risk, these are perfect securities to use most of the time. What are the two potential outcomes without exit strategies? Either unexercised, we generate cash flow, and then we use that cash, if it's unexercised, to secure another put for the next contract cycle. Or if it is exercised, we allow exercise. In other words, we make that determination if we're going to allow exercise. If we do, well, then we purchase the stock at a discount. You saw those discounted prices in this discussion. Once again, let me just reiterate that these are low risk, not no risk strategies. Steve?
Wow, that was really good, Alan. I think that a lot of times people don't always understand that risk is always in everything that we do. But when you can lower that risk while still owning the asset and still making money and protecting your portfolio is an amazing thing. I mean, I think right now, Alan, we're looking at, a very volatile time, and being able to lower risk but make some money on it. I like that, and you are the master of that. So I appreciate that. And listen, out there, if you're not listening, listen to him right now. I mean, this is literally Alan Ellman himself. He's going to tell you everything about it. And when I look at forward thinking in this market, he's the guy that's going to help you, because right now, as I've been saying, this market's a little bit risky right now. And if you can lower the risk, make money, this is the way to do it. So, Alan, I appreciate that, and we'll see you right back here next week, my man.
Speak to you then. Thanks, Steve.